We're in an environment where investors have actually gotten used to making 1% a year on their money, which personally I find depressing. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and we have much higher aspirations than 1% a year, I assure you. In this video, we're going to share with you how one trader has developed an approach to pretty safely earning 1% a week, which last time I did the math translated into 52% a year. So if an approach like that is interesting to you, then I'd suggest you stick around because I think you're going to find this pretty eye-opening. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so a lot of the aspiring traders that we work with are professionals, lots of doctors, lawyers, engineers, and business owners who, like me, have a very hard time understanding why investors would settle for the kinds of historically low returns available in the capital markets these days. It always amazes me that people actually rush to buy 10-year treasury bonds for the privilege of letting the federal government hold your money for 10 years for 1.25% a year. I don't get it, and I don't find it acceptable. And so lots of people explore alternatives that have the potential of providing far superior returns. And in our space, they are known as options income traders. So recently, I had the opportunity of working with an aspiring options trader who has a goal of generating 1% per week on his capital. And so the way that he's attacked this goal is by setting up high probability options trades using index options that will yield 1% a week. So to make sure that everyone watching this video understands how index options work, we're going to do a really quick review of that. And for those of you familiar with how they work, just hang in there. This is going to be really quick, and then we'll jump right back in to teach you this eye-opening example of how you can potentially make 1% a week instead of 1% a year with option strategies. All right, so the best way to understand index options is to think of them as a bet. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that an option expires. If the index does close above the price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of that put. So for example, if an index closes at $4,032, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closes 32 points above the strike price of the call, which is 4,000. However, the 40.75 call, that one would expire worthless as the index didn't close above 40.75. So the call seller just pockets the premium, and the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, so bearing that in mind, let's take a look at exactly how this trader is approaching his desire to make 52% a year on his account. So let's head back to May 28th of this year. And so if you look at the Russell 2000 index, known as the RUT index, you'll see that at that point, it had ranged from a low of 1927, which actually took place on the first trading day of the year, and as high as 2360, which took place in March. And it's sold off a bit since then down to 2269 on this day in late May. And so what the trader likes to do is to enter into a high probability options trade. And let's show you how that works. So on that day, he takes a look at the options chain that expires 49 days later on July 16th, and he sells 20 of those 2480 calls, which are 120 points above the market. And then 50 points above those, he buys 20 of the 2530 calls. And simultaneously, he heads down to the 1830 puts and sells 20 of those. And finally, he moves down 50 more points and buys 20 of those 1780 puts. Now, combining options this way in the same expiration options chain is what is known to options traders as an iron condor. Now, before we get into how entering into an iron condor actually helps this trader to implement his plan to make over 50% per year on his account, if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, or how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open a free workshop registration page in a new window. So don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this. So pause this video, sign up now, and then resume watching. As we mentioned, the trader has entered into a 49-day trade designed to provide him with a 1% return on his capital each week. So to understand how this accomplishes that purpose potentially, let's look at the cash flow implications of this trade first. And as you can see, he sold 20 of those 2480 calls for $5.55. But remember, they pay out $100 per point above the strike price. So you multiply that by $100, and we bought 20 of them. So that comes out to a total of $11,100 for the calls we sold. But we turned around and bought 20 of those 2530 calls for protection. And so 20 of those cost $5,900, as you can see from the calculation. He also received $10,500 for selling the 1830 puts and paid out $8,300 for buying 20 of the 1780 puts. And so if you put it all together, you can see that the trade brought in $7,400. Now your broker will margin you $100,000 for this transaction, which basically means your broker is setting aside $100,000 to make sure that you've got enough in your account to pay off any obligations that the trade might incur. And so you can very conservatively think of that as the capital that you have in the trade. So let's take stock of what's happened so far at the initiation of the trade. And as you can see, the trader intentionally created a kind of bracket around the highs and lows of the year by placing the calls well above the highs for the year and well below the lows for the year. And this was done intentionally, and you'll see in a minute why. So now let's move forward to the day these options expire on July 16th. And as you can see on that date, the Russell 2000 index closed at 2163.70, well below that high of 2360 for the year in March, and well above the 1927 low for the year, which took place in January. So what are the implications of this? Well, let's think about it. Originally, we received $7,400 for entering into this trade. So now we need to focus on the expiration value of each of the options. Well, the 2480 and 2530 calls were both well above the market, which closed more than 300 points below those calls. And those calls have no value at all unless the market closes above their strike price. So both of those become totally worthless and just expire on July 16th. And the same logic applies for the puts down at 1830 and 1780. Both options expired more than 300 points below the market. And again, unless the market closes below the strike prices of the puts, they also expire worthless. And so both the calls and the puts expired worthless, leaving the trader with the $7,400 that he initially received. And so that in turn translated into a 7.4% gain over that 7-week period, which comes out to a little more than 1% per week, which remember was this trader's goal. And so the important lesson from today's video is that iron condors can give options traders a great way of earning income in a relatively safe way by doing a look back year to date and then selling options way above and below the highs and the lows of the year and buying options for protection beyond those in the iron condor formation that we taught you in this video. If the market simply stays anywhere between the highs of the year and the lows of the year for those next 7 weeks, then the trader pockets 1% a week, exactly what happened in this case. Now, of course, there will be periods where the market will break through the highs and the lows of the year, which could cause a loss. And so it's probably a good idea to target higher than 1% weekly return for each trade so that you can build up a bank for that period during the year where the highs and the lows have been exceeded. But this is such a high probability trade that if conservatively positioned, as we did in this trade, the chances of that happening are really not very high. These kinds of strategies can produce startlingly strong returns over a 1 year period once you understand how to trade them and position yourself to take advantage of the natural ranges that form in the market around the pricing of most assets that are optionable. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world options trades that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open a free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And just to remind you, please subscribe to our channel so that you can take advantage of all of the valuable videos that we produce to help you to improve your game as an options trader.